Hey everyone, how's it going? It's Russell here, and it's getting riskier to own a home in Canada. And while that might not sound like too much of a surprise to you, some big players like the Bank of Canada and other banking regulators are starting to take notice of some specific details that have them concerned. So in this video, we're going to go over exactly what this new data is and how it's making Canada a riskier place to live. And make sure to stay until the end because we're going to go over some of the details on how you can protect yourself from some of these risks, whether you're buying a house for the first time, have never owned a home, or own one now. But before we do, make sure to check out the links in the description where you can get 2 free stocks with Wealthsimple Trade when you sign up for the first time, or check out the Canada Money Mastery Program, 40% off with coupon code GROW, where we talk all about building wealth right here in Canada. All right, now let's get into this new information. The first thing we need to talk about is loan to income. Now, this is something that bankers and regulators use to determine just how in debt someone is from their home. It's called the loan to income ratio. And this is exactly what it sounds like. It's essentially the size of the loan that you're taking on compared to your income as a family that's qualifying for that mortgage. If you took on a $4 loan and had an income of $1, well, essentially your loan to income ratio would be around 400%. And the same goes if we amp that up and we say, hey, maybe you're taking on a $400,000 loan for your home and you have $100,000 of income. In this instance, your loan to income ratio would be the exact same at 400%. That's essentially how this ratio works. Canadian regulators believe that a loan to income ratio above 450%, or $450,000 worth of loan for every $100,000 of income you have, if you're above that, they consider you highly indebted. And the Bank of Canada actually just released some new information on just how many more Canadians are receiving mortgages when they're considered highly indebted in terms of loan to income. Take a look here at this data on Better Dwelling. It's super easy to understand. Essentially, all 3 of these lines are all representing Canadians with a loan to income ratio higher than 450%, and how much that has increased relative to other mortgages that are at different rates, lower than 450% for their loan to income. In every category, whether it be an uninsured mortgage where they don't have to pay mortgage insurance, or insured mortgages, we're seeing that number come up with the total at around 21.7% of mortgages in general in Canada being qualified as highly indebted. Now, there are actually a couple things that are supposed to stop this from happening as much, like the lowest interest rate mortgages going to only people who have good loan to income ratios, but there are some things that are changing that, with more and more Canadians co-signing with their family members to help them qualify for a mortgage for the first time. That could potentially get them past those mortgage qualification issues, as well as potentially many Canadians feeling like they want to buy into a hot real estate market, going to secondary mortgage lenders who are willing to take on the additional risk of higher risk borrowers, but they're charging a little bit more interest. And it makes some sense. When you've grown up in an environment where real estate prices only ever go up, it can make sense that you'd start to believe, hey, real estate prices are only going to go up, so I can sort of rationalize this higher, riskier mortgage rate. Now, the second thing, and these 2 things are going to combine together, so stay tuned for that, is called loan to value. This is a very similar sort of metric as the loan to income number we talked about before, but it's a little bit different. Let me show you why. This one's a little bit different. Instead of it just being loan to income like the previous one, this one is called loan to value. Essentially, what this describes is the size of the mortgage that you're taking on relative to the value of the home that you're buying with that mortgage. If you're buying a house that's worth $500,000, then obviously you're going to need a mortgage to buy that. Now, this is what determines what the loan to value is on your mortgage or on your home. If it's a $500,000 home, let's say you have a $100,000 down payment. That would mean you're going to pay $100,000 at closing of the home, but you're going to need a $400,000 mortgage. So essentially, the loan that you would need for that mortgage would be $400,000, and the value of the home is $500,000. And from that, we can get what your loan to value is. This would work out to 0.8, or what we'd call 80% loan to value. Essentially, the higher your loan to value is, the less equity you have in your home, because more of a portion of what you bought your home with is loan rather than the actual dollars that you're putting in as a down payment. Where we're starting to run into some problems right now in Canada is the fact that we're having people with very high loan to values and also with very high loan to income ratios. That's sort of like the double whammy that's sort of working together here and making making some people concerned. This chart compares loan to value to loan to income and tells us what percentage of new mortgages are being issued at these different rates. Essentially what the chart is telling us is that mortgages with people who have a higher income and a lower loan to value, essentially the less risky side of things, well, we're actually seeing decreases in the amount of mortgages that are being issued that meet those qualities. Now, on the other hand, over here, we have more and more mortgages being issued with people who have higher loan to values and higher loan to incomes, essentially meaning that they're stretching themselves further to buy the home. The issue isn't just that people are taking on more debt and having to pay a larger portion of their income for their mortgage, it's also actually that their loan to value is low as well, meaning that they actually can't weather as many financial storms. Let me explain what I'm talking about. Imagine you bought a home and some unexpected repair came up or some other financial stress. If you had just bought that home and you had a high loan to value, essentially meaning that most of the value of the home is all tied up in that mortgage, well then not only would you have to come up with the payment for the mortgage itself, but you'd also have to come up with the cash to weather whatever financial storm that is. Maybe a furnace went out, maybe there's some other unexpected thing that you have to pay for. Now, on the other side of things, if you have a lot of equity in your home, maybe you've owned it for years and have slowly been paying off the mortgage, or you're somebody who just bought with a large down payment, well, then you have options. If the same repair just came up, you have options to pay for it that aren't just coming right out of pocket. If you have equity in your home, essentially you can tap into that equity in the case of an emergency through things like HELOCs or home equity lines of credit. This allows you to sort of treat the equity and the money that you have sort of tied up in your real estate. It allows you to take that money out and use it at a super low interest rate. This gives homeowners with high amounts of equity more ability to sort of smooth over those rough financial patches than people who don't have as much equity. Obviously, as you can see in the charts that we looked at, with people stretching themselves further and further to buy a home and having less and less equity in the homes that they do buy, you can see why Canada would be at a higher risk of having the housing market negatively impacted if there was a financial downturn or any sort of other event that could negatively impact people's finances. For instance, if interest rates shot up like they did in the 80s, many new Canadian homeowners wouldn't be able to afford the mortgages that they currently have today, and because they don't have as much equity in their home, they can't sort of take that equity out in order to weather any of those tough financial stretches. While at the same time, I can see why people are taking on more and more risk in order to own a home, especially when we look at what happened at the very beginning of the pandemic, a major global shock that we thought was going to potentially trigger us into another Great Recession. Almost immediately, the Canadian government implemented a number of measures and sort of put a safety net under homeowners saying, hey, you can defer your mortgage, you can pause payments for a little while just to help you out through the beginning of the pandemic. And with this sort of perception that Canadian real estate is just too big to fail, you can see why people are doing more and more to try to buy in now. But regardless of what supports come from the government, there are a couple things that you can do now when you're thinking about buying a home that can save you from some of these risks. The first thing I'd recommend is looking for baked-in equity or equity that's already there inside of the home before you buy it. Now, you can find homes like this if you look for things that really don't look that cosmetically appealing. Maybe they're a fixer-upper, you need to do a lot of cosmetic changes to sort of bump it up to a livable status. At that point, oftentimes the real estate will sell for less than its actual market value, even when you consider the renovations you'd have to put it in to get up to that market value. If you can find the right property like this below market value, and deals like that do exist if you're working with the right people, then oftentimes, even if there's a downturn of say 5-10%, you're still not going to be underwater on your mortgage because of that baked-in equity that you got as soon as you closed on the house. The second thing that you should absolutely consider is house hacking, and this is something that we talk about a whole heck of a lot more in the Canada Money Mastery program down there in the description. Take a look at it if you're interested. But house hacking will actually allow you to rent out a portion of the home that you're currently in to help to supplement the mortgage. This can have a huge impact not only on how much you can save and invest today, but how much you'd be able to weather a storm if there were some sort of cataclysmic event that made everyone's financial life here in Canada a whole lot more tricky. And as an obvious disclaimer, nobody has a crystal ball and nobody knows exactly where the real estate market is going, but I do believe that if you buy with the right fundamentals, you can still find properties that make sense for you. And with that said, let me know what you think about all of this. Do you think that Canadian real estate is getting a little bit out of hand, or do you think it makes sense based on what the Bank of Canada is doing and what the Canadian government is doing? Let me know down there in the comments, and if you haven't already done so, check out the links in the description. Remember, you can get 2 free stocks with Wealthsimple when you sign up, $25 bonus when you buy $100 worth of cryptocurrency on Newton, so check those out if you want to continue to support the channel. But with all that said, thank you so much for watching, everybody. I really hope this video helped you out at least a little bit, and I'll see you next time.